Hello, welcome to May's Market Update. My name is Tyler Sanchez. I am a financial planner and research analyst here at the Rice Partnership. I'm joined by Ashley Wilken, Senior Wealth Manager.
Hi, everyone.
Today, we're going to be talking about investing principles to keep in mind in times of volatility. Start, I'll catch everyone up with where we stand in the stock market. As of yesterday's close, the S&P is up 60 basis points and the US Ag Bond Index is up 1.90%. Despite modest gains in both asset classes, we've seen plenty of volatility in some of the largest single-day moves in S&P history. The market peaked at the end of February and entered correction territory in mid-March. We saw one of the largest two-day moves in the market history. On April 3rd, we saw a 4.84% decline in the S&P. On April 4th, the market experienced a further 5.97% drop amid escalating trade tensions. Just 5 days later, on April 9th, all three major indices posted their largest single-day point gains, with the S&P ending 474 points, or 9.5% up, as tariffs were put on pause. Earlier this week, we saw the market make a return to neutral for the year. With the past 2 months in the rearview mirror, Ashley, how does the strategy of staying invested in the market compare to attempting to time the market in terms of its long-term impact on an investor's portfolio?
Thanks, Tyler. Yes, if investors are just looking at the market year to date and didn't have all the detail that you provided, it would look like a kind of boring year. But in reality, it's been a roller coaster of a ride. And I think this just proves the point that, trying to time the market is not a winning strategy. And that's been proven time and time again. Going in and out of the market and trying to avoid downturns usually ends up with a worse outcome than staying invested throughout downturns. Historical data can prove this as well. So if you were invested in the S&P 500 over the last 20 years, your average annual return would be about 10.4%. However, if you missed the best 10 days out of the last 20 years, your average annual return would drop to negative 0.6% annually. So a significant difference, between maintaining, being invested throughout the whole time versus trying to go in and out and potentially missing those big days. And, another thing to remember is those historically big days usually happen during bear markets, like what we've seen this year.
Great. And with a lot of the volatility based on trade tensions and other political variables, should investors make changes to their investment strategy based on today's political climate?
That's a great question, and a question that we get a lot. Historical data again shows us that no matter what political party is in office, the stock market generally goes up during each presidential election, with only a few exceptions over the last 60 years. That being said, clients should not, rely on the current political climate to determine their strategy. What they should do is determine an investment strategy based on their own unique circumstances, including their time horizon, their cash flow, their risk tolerance, and their overall financial plan. So that's why, working with an advisor is important to determine what your individual strategy should be, and not just relying on, news headlines to determine that strategy.
And finally, in times of volatility, we see investors generally flock towards quality and the more defensive sectors of the market. So how can investors take advantage of S&P sector rotations in volatile markets to diversify and lower the risk of their portfolio?
Yeah, our clients know that, our investment team will change our allocation to certain sectors depending on what the economic outlook is. However, we normally maintain some type of position in each of the large S&P sectors, no matter what the economic outlook is. So for example, if we thought the economic outlook was negative, we might trim consumer discretion stocks because those historically get hit hardest during a recession. However, we're still going to maintain a position in consumer discretion and not get out of it completely, because when the market rotates again, you want to have an investment there and not be trying to chase the rally because you got out. So, overall, we want to maintain an investment in all the sectors throughout every economic cycle, even though we might trim or overweight different sectors, depending on where we are in the cycle.
Thank you so much, Ashley, and thanks to everyone for watching.
Have a good day. Thank you.